I'm pleased to welcome back to the show Gary Wagner, editor of thegoldforecast.com. Gary, it's been a while. Welcome back. Good to see you.
Great to be here. Good to see you also. And lots of interesting facets to what we're witnessing in gold right now.
I'll start with my main question for this interview, which is why I invited you back on this particular week, which is $4,300. It's down 20% from its highs already, 21%. This looks like, if I were just to look at a chart from a purely technical perspective, some people have pointed out to me, it looks like the beginning of another 2012 style correction, where we saw a top, it corrected a bit, maybe bounced back a little bit towards its previous top, failed to meet that top, then crashed another 40-50%. It's happened twice now in the past two bull cycles, 2011 and also 1980. Is this time any different?
Well, there are a couple of distinctions that I think could support gold. The first part of your question was looking at the gold price over time through the eyes of a technician, a chart, and a couple of studies. As you'll see when we pull up some charts, gold has effectively broken and stayed below the long-term 200-day simple moving average. To a market technician, we look at long-term trends of a stock or commodity, in this case gold, as to whether or not current pricing is above or below that moving average. It is below. On a technical basis, once it broke below, on a daily chart, maintained that level, we moved at least short-term into a bearish scenario. We did find a bottom. The bottom we found was right around $4,045, and then it popped back up pretty dynamically. Of course, this happened last week. I do believe there's fundamental reasons we will see support in the market, even at these elevated levels, although, as you just correctly pointed out, 20% below that record high. I mean, we've come down substantially from well over 5,500 to testing right around 4,100. That's a substantial move. But there are a couple of key reasons I believe it could be supported. We'll go into that. But to answer your question, yes, we've sustained technical chart damage. We are definitely in a correction. Could this correction lead to the type of scenario that we saw back in 2012, which was a multi-year correction, really halving the price of gold from about 2,000 down to about 1,020 at the end of 2015. And I remember that point well, because as it came down, we were wondering where it would find support. And the report that came out in February was George Soros was actively buying, which gave me the belief that there is a possibility that this could be a bottom, that it finally went to a price where professional traders, hedge funds felt this is the point to re-enter, to buy the dip because it's priced correctly.
Okay, let's take a look at the chart then. Please pull up a chart on your screen. We'll take a look at the technical levels and try to understand why $44,000 is a critical support zone, and whether or not 4,300, which is where we're currently sitting at, means more consolidation or more of a breakdown up ahead.
Absolutely. As you can see, what I've pulled up is a daily chart of a continuous futures contract of gold. You can see that on Thursday of last week, on the 11th of June, we actually touched the bottom of this green line, $4,045. That was short-lived, though. As you can see, after hitting this all-time record high up here, that came in, of course, at the end of January. We hit a series of lower lows, the first one, the second one, and then the breakthrough here, the third one. I've got green arrows showing that they were support in this area. You can see the red arrow signifying that I believe it's currently resistance. The other thing that we want to look at is I have two moving averages up. The green moving average, which is my shorter term 50-day, and the longer term 200-day. You can see as they widened, that's when we were really seeing a huge move, and realize by the nature of using moving averages, they lag greatly behind real-time data, especially a 200-day and a 50-day. But you can see how these have narrowed tremendously, narrowed where the 200-day and the 50-day is coming closer. If it actually would cross that would be a significant level of chart damage, but we're not quite there yet. My sense is that I believe that around $4,000 will be a floor in gold, and it's simply based upon the low that we saw last week. And if we carry that back, you can see that this was also an area of support. We could move it back a little bit further, and then if it did slip lower, that would be the next level. But right now, there's some data, not exceedingly strong data, that suggests on a technical basis, because of this bottom here, that this could be the floor. My assumption right now is it's going to be, and later on I'll explain why I believe that to be in terms of fundamental events.
Before we continue with the video, let's talk about one of the fundamental problems of owning gold. There's a lot of reasons to hold gold. It's often viewed as a store of value, for example, but in most cases, gold doesn't generate income. Today's sponsor, Monetary Metals, fixes that problem. Monetary Metals introduces a model where gold can produce a yield paid in physical gold. Through their leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces. Your returns are measured in gold itself, not in fiat currency terms. In an environment where most assets depend on price appreciation alone to justify holding it, this model allows gold to serve as both a store of value and as a source of income. The metal remains your asset and can be redeemed at any time. Thousands of investors are already earning a monthly yield in gold through Monetary Metals. So visit monetary-metals.com/Lynn today. Link in the description down below, or scan the QR code here on the screen to learn more and get started. Well, Gary, if you take a look, I don't know if you're able to zoom out a bit and look at more time history, but if you take a look at how the prior bull cycles have ended, historically, gold has corrected a lot more than it has currently before troughing, before reaching a bottom. And
how far do you want to go back, David?
Let's just take a look at 2012, 2011, and show us how far it's declined from the peak in 2011 to the trough in 2012. And I want to draw that parallel to today and see if a similar price action is going to occur.
Now, of course, it's to scale, but not to scale. Let me
I believe it's 40%, if my memory is correct.
Yeah. Well, you can look here.
Peak to trough.
You're looking at about, call it 1900. Mm-hmm. And from 1900, it moved down to 1200, continued to drift lower to this is the end of 2015. So this is the low. I'm going to round 50%. It down to 1,000. So from 1,900 down to 1,044 is well over a 40% retracement from the former all-time record high. This occurred in the middle of 2011, down to these levels that really ended in 2015. Then we saw a slow move up, first to 1,300, a correction down to 1,100, would stay the same. It would bottom at around 1,175. And then this was the first of many peaks at 2,041. The reason that's so important is that comes just above this former record high. So we had a new all-time record high. It came back down. We matched that record high not once, but twice. So we literally had a triple top. It consolidated, and this little box here is simply to signify the point in which everything changed. Look at the tact or the angle of the rally. Really beginning in August of 2023, when gold would move from about 1,900, and it would stop along the way for a short time. It's highly compressed. 2,400 here, 2,700 here. These are all new all-time record highs. We would witness that once a week or something at one point. Then we had this top at 3,400. This top here at 4,000. And of course, the all-time record high, which actually goes, I'm looking, the wick is very light, but almost to 56. I always say above 5,500. And then we had this deep correction. When you look at the correction, even if we look at it from 4,000 to 5,500, it came down about 60% of the way. So we have had really steep corrections. The correction that we're looking at now is nowhere near as deep as the move from 1,900 multi-year down to 1,000. To do that, we would have to go from, call it 5,500 down to just below 3,000. And the low that came in where I'm looking at potential supports 4,000. If this area holds, and that's a big if, but if it holds, it will be a much more shallow correction than many other instances in which gold traded to a new all-time record high and corrected. And I think the key difference right now, it's not the war in Iran. They've kind of put that to the side, believing now we have a peace agreement. We'll see if it holds, but that would be something that would be contained and short-lived. So that wasn't it. We do have inflation, heavy inflation, 4.2% from May, as reported in the last CPI. However, that was 60% of that was based on higher energy, and crude oil has fallen out of bed. It is really coming back down. I would look for it, if it's not there already, to go back to around 80, and 80 being a benchmark. The key right now, David, more than anything else, is the acknowledgement, and this is from the World Gold Council, that the biggest purchasers of gold this year that are going to be actively accumulating gold are the central banks. I forget the actual numbers, but according to one article, they said that they interviewed a lot of the central banks, and the survey found that 57% of the respondents are now switching gold from where it's being located for safety reasons, but they're active buyers. The central banks are believed to are believed to accumulate vast amounts of gold over the next year. And that's according to a survey by the World Gold Council to all of the central banks. Yeah. And so the central banks are large purchasers of gold. That's not like retail investment. It's not even like hedge fund investment. When central banks are buying and they're converting their fiat into that hard asset, one, that tells me that they're losing faith in whether they're overseas working with euros, whether they're in China working with yuan, regardless of their local currency or the currency that's a primary currency in the central bank. The fact that it is such a high percentage of central banks that responded saying we're going to be actively buying and adding gold to our positions, to me, that is significant. That's the most significant thing that I believe, if anything has the opportunity to move gold back into the positive. And when I say the positive, once again, I'm just looking at the chart and I'm talking about it moving back above $4,000, which was a low that we hit, 4,045 last week. And that's basis of futures contract, not spot.
Do you think gold has moved away from being just an interest rate story to something more fundamental, or sorry, not more fundamental, but different fundamentals is what I'm trying to say. The Fed meeting is tomorrow. We're speaking one day ahead of the FOMC on Tuesday the 16th. Kevin Warsh is expected to remain more hawkish than not, and we'll find out what exactly he says tomorrow, Gary. But I wonder if interest rates alone are going to move the gold story going forward. What do you think?
Well, first of all, the thought of there being an interest rate hike has been a significant driver of lower gold prices. Obviously, gold is a non-interest bearing asset, so that when interest rates go up, that makes gold less attractive because fixed income investments are yielding higher. And so that will move money out of gold and silver, the precious metals, even equities to some degree, to move them into the safety of a fixed interest rate bearing investment. So interest rates have been the primary instigator of this latest move down. I think that had a lot to do with it. Consider this. We've seen to some degree paradigms change, but it's much more subtle than that. Typically, if we had great strife and geopolitical uncertainty like the war in Iran, that would move gold higher. What did we see on this occasion? We saw gold move down as that war moved into deeper and deeper conflict. I believe that it moved down, one, because they were looking at interest rates more than geopolitical uncertainty. And I think the key right now in terms of the Fed is he's supposed to have a more hawkish stance, but he is Trump's guy. What I'm going to be interested to see, nobody's expecting a rate cut at this meeting. I think the odds of that are extremely low. However, it's about 60%, according to the CME's FedWatch tool, that there will be a rate hike this year. And when you think about it, if I'm correct, and I might not be on this fact, but the last time the Fed raised rates, I believe, was July of 2023. It's been a long time since we've seen the Fed actually raise rates. And that's why once that door is perceived to possibly be open, a rate hike might turn into a cycle of rate hikes. Mm-hmm. What we've had is rate cuts, and that's what's fueled the economy for, ever since the pandemic. We actually, at that point, took rates down to, 0.25%. And I'm speaking about not what you and I can borrow, but Fed funds rate. The interbanks charge when a central bank loans money to another bank was about 0.25%. As close as you're going to get to zero. You really can't go negative. There's been times that Japan did it, but I don't understand the concept of negative interest rates. I would love that where I can borrow money and they pay me for borrowing money. But to get it down to 0.25%, now we're sitting below 4%. The key right now to me is inflation. Inflation is sitting at 4.2%, with the predominant amount being directly derived from energy costs. And if those come down, it will take time to work it in the system. I believe that national gasoline is around $4 or $5 a gallon, where a year ago it might have been $3 to $4. Even if oil comes down and effectively the strait gets open on Friday, and it's considered to be a more peaceful time with free trade going through that key and critical strait, because whether it's 10 or 20% of the oil is carried through that corridor, that's a decent percentage of a product that we live on because we are a petroleum-based society, whether it's used for gasoline or for transportation or the production of products. Plastic is used, and plastic is a petroleum derivative. So that's going to be important. If we see the truce hold, there's going to be a 60-day period where they come to a long agreement. If by chance they are able to work that out and this truce isn't broken, because to me, that's the biggest uncertainty factor, is whether or not it will hold. There's been multiple occasions where they attempted a truce and one side or the other broke it. So if in fact they can hold the truce, have longstanding peace, and I don't see a reason not to. The reason we went into Iran is highly different than maybe what should have happened, but it did happen, and that's what raised energy costs, and higher energy costs is what greatly led to the higher inflation. So we do have the opportunity, should things work out, to see inflation move back down. But even if it moves back down, David, if the Fed's going to truly maintain a 2% target and we're at 4.2%, it might, let's say it takes it to 3%. We're still well above the Fed's target, and it's just keeping up with the pace of inflation in terms of pay raises. So the biggest disparity and discrepancy we've seen this year is that increased income and wages in the United States and Canada have not kept up with inflation. So even if people were making 3% more per year, they were pretty much losing money on the buying power of the currency. And that doesn't keep your citizenship happy. If you can't buy a gallon of milk, a loaf of bread for the same amount you paid last year, what does it matter that you got an incremental raise when the cost of goods are far above that incremental raise? And that's going to be the issue.
Tell us about why gold didn't behave as some traditionalists would expect it to this year. I'm talking about gold's reaction to not just the Iran war, but also inflation. We've talked about this at the onset of the war. Let's address this now that a memorandum has been reached between the Iranians and the Americans. So we have more data now to assess this. Gold has historically been seen as an inflation hedge and a hedge against geopolitical uncertainty. It's done neither of those things this year. In fact, it's gone down as inflation print's gone up, and it's gone down as geopolitical tensions ratcheted up in the Middle East. Why is that?
Well,
and has that changed the narrative for you?
Well, the only way I'm going to answer it is truthfully how I feel. It's a quagmire.
Sure.
There's not a clear-cut reason for why we've seen that paradigm shift. I remember when it first occurred and I saw gold going down and military action going on in Iran. I said, there's something unusual happening here. Is this truly a paradigm shift? And to me, if gold is going to remain the absolute hedge against inflation, hedge against uncertainty, or a major hedge, let's say, not the ultimate, then that paradigm really shouldn't shift. Now, it might be that the conflict in Iran and the United States wasn't perceived in the same way we perceive the war between Russia and Ukraine. That's a multi-year thing. Nobody sees any kind of real solution when there's both sides want certain things that are, what do you want to call it, that have to be accomplished before they'll accept it. In other words, these are key pegs. If Russia's going to stop the war, they want this land here. The Ukraine says, if we're going to stop the war, you need to stop bombing. We'll stop bombing, but we're not giving up any of our territory. So those are issues in which it seems as though each side is unmovable, whether you want to take sides or not, whether Russia has a right to take this land, whether or not Ukraine has a right to keep part of their sovereign territory, which is kind of where I think the logic stands. You have an unbendable set of negotiations in which neither side will give up certain key parameters to achieve peace. So when you get something like that, you have a sustained military conflict that goes for years and years, and that's what we've seen between Russia and Ukraine. It's different than when Trump went in and had military action against a country in the Middle East. On the surface, he said it was because they don't want them to have nuclear weapons. None of us know what this agreement says, how deeply it mentions, and whether or not Iran, somewhere in that agreement, has agreed to stop enriching uranium. If it's in there, wow, that would be great. If it's not, then why did Trump go in stating this is his end game and did not achieve it with the agreement that was reached? We don't know what that agreement says. So that's what I believe we have to get more information on.
At $4,300 gold, with everything you just said, the macro backdrop that you just excellently provided, Gary, what is gold to you right now at this current price level? Is it an investment? Is it a speculative trade because you believe there's more short-term upside? Is it a sell opportunity? Or is it just something to stay away from?
It depends on your goals. Now, I can tell you for me, I have been very slowly accumulating physical gold, holding it in a safety deposit box. As it got really over about 3,500, I slowed down to whereas I put that on pause because I didn't know how high it would go. And, it was at 3,500. And when that was an all-time record high, you're not certain it's going to go to 5,500. If I would have known then what I know now, I would have continued to buy. Now, I believe that people that have taken the advice of many advisors, including myself, which is that all portfolios should have 10 to 15% of their assets in something like gold or silver, physical gold or silver. If you've been following that rule, you've already got some kind of a stockpile. So at this level, you want to add much slower than you would typically accumulate, but you still want to accumulate because we know we now have a really hard ceiling above 5,500. That's where the record high is. You can buy it right now for under 4,100. I'm sorry, 4,350. That's how fast it's moved off of this. So my recommendation for those that have been actively accumulating, you want to continue to do it at a slower pace. For those that are just considering that, let's say you've gotten out of college, you've worked for a couple of years, and now you're trying to decide how you allocate into stocks, bonds, and things like gold or silver. You still want to look at 10 to 15% as a max, but at this level, you might only want to put 7 or 8% right now until you see it back up on a strong upswing. You certainly don't want to liquidate, at least in my opinion, because it's such a, when you're buying physical, it's a it's a decade kind of investment. When I buy something like that, it's probably going to go to my kids. I'm not looking to do anything with it. Luckily, I've never had to liquidate it. So I will continue to accumulate, but at a much slower pace. For those that are just getting started, rather than looking to allocate 10 or 15%, initially try to allocate 5%. And if it does move down to different levels, so let's say, for example, it did break below 4,065, my next major level of technical support is about 3,900. You'd want to allocate more there, dollar cost average on the way down. If it breaks below there on a technical basis, the next level doesn't come into about 3,400. But I say that with one huge caveat, and that is fundamental events rule. That's what moves the price of gold, not the number on a chart. The technician is able to look at valid points of potential levels, and we always have to say it that way, potential levels of support and resistance. Right now, I'm looking at major support right above 4,000, so I feel safe in buying it, but accumulating it in small amounts rather than medium or large amounts, with the goal of maintaining 10 to 15% of my portfolio in physical gold or silver. And I think that that's a good rule of thumb. Even if you're just starting out, you might want to start out, rather than allocating 10 or 15%, allocating 5%. If it does move lower, use that as an opportunity. I don't see a free fall here. And the reason I don't see that is if central banks are going to be actively accumulating, that should hold a floor on gold. That should create the bullish momentum that faded. That could drive that back into existence.
Well, what about silver? Is silver the same narrative as gold right now? And we'll finish off here.
Okay.
Take a look at chart of silver.
Sure. The last thing I would say is silver is a safe alternative.
Silver has also fallen from its highs. Now, you'll recall that silver has reached unprecedented triple-digit levels. It's still high by historic standards at well over $69, $70 as we speak right now. Well off its highs of 120 though, just a couple of months ago. And so the question is silver now dependent on the price of gold, or do you think silver's charts look like it's moving independently? What do you see?
First, I see silver moving to a different tune, a different drummer, any way you want to say it. There's been a tremendous disconnect to a degree. And the degree I mean is typically you will see gold and silver move in terms of the direction in the same direction. Gold and silver tend to move up when there's bullish market sentiment for the precious metals, and down when there's bearish market sentiment. The one thing that to me stands out, this red line that we're looking at is the 200-day moving average. And you can see that on last Thursday, the 11th day of June, it actually moved into it. And then on Friday, yesterday, and today, its price point has remained above the 200-day. We've seen the narrowing between the 50 and 100. But the key is, if you recall from the gold chart showed that gold was well below the 200-day moving average. Silver is not. So in that way, it's been more sensitive, but yet it has shown a more bullish inclination because, again, as a market technician, if silver's above its 200-day moving average on a long-term basis, it's bullish. If it's below, it's bearish. So if we use that as kind of a benchmark, and the 50-day is a short term, of course, then silver is back in a long-term bullish scenario. And when we look at it, and I can compress this to a degree where you'll see, here's the last time silver dipped under this was in April of 2025. Look at how these two lines widen. Look at the width that came between in the middle of March this year, and realize that during that time, you had this tremendous sell-off. You then had a lower high, lower high, lower high, low, lower low, lower low. Whenever you've got a series of lower highs and lower lows, by definition, that there's selling pressure, because you're going to get higher highs and higher lows in the market moving higher. So we're not out of the woods yet, but there's a ray of hope in the fact that silver has come up, whereas gold has not. And so to me, when I see something like this, as I continue to accumulate, I'm going to look to accumulate silver rather than gold, or if I'm doing both, more silver than gold in terms of dollar investments. And that's what I've been doing. Since recently, I've been purchasing small amounts of silver, and I've kind of held off on purchasing gold.
Finally, Gary, what would change the Fed's opinion on rates this year? Either what would motivate them to continue hiking, which is what the markets are predicting they would do by the end of the year, or start cutting rates?
Only one word: inflation. If inflation, which is at 4.2%, moves down to 2.5%, it's close to their 2% target. At 2%, they probably would consider cutting rates. But as long as you have inflation elevated, and when I say elevated, it's relative. I've lived through Clinton era periods where we had 15% inflation. I mean, I've seen inflation. Anyone that's 50 or older has seen real inflation. Not to make this a non-starter or an unimportant point that it's at 4%, but relative to where we have been and where we are, inflation has become extremely elevated. The key is, when you look at the Fed's dual mandate, maximum employment and inflation around 2%. If employment stays strong, but inflation continues to grow, they work their one tool. Their only tool is to work with interest rates. It's the only real tool they have. They can raise them, keep them the same, or lower them. And so they're going to act appropriately based upon what the most recent numbers of inflation are and the predictions of where it may go. So even though it's relatively high now compared to what it was a year ago, it's based dominantly on high energy costs, crude oil, and that can be explained by the conflict in Iran, because they shut down the straits, and that's where a good portion of oil comes out of. If, in fact, they resolve the problem and maintain that truce and come to a lasting peace agreement, we will see crude oil back down on a long-term basis. We saw a tank over the last couple of days, but it could easily go up if the truce is broken. So what the Fed is looking at more than anything else is inflation, as well as maximum employment. Employment hasn't been a big issue, but inflation has been the primary driver of what's on the minds of the Federal Reserve members. The second thing is, we're so used to Powell being the chair at the head of the Federal Reserve Bank that we want to really see, and we won't see it except maybe through statements in the minutes. And that doesn't come out tomorrow. We'll just get a press, I believe, because Powell had a press conference at 9:30. That's my time. 9:30 in Hawaii, but I believe that's 3:30 in on the East Coast. He would hold a press conference on Wednesday following the FOMC meeting. So that will conclude on Wednesday. I would imagine that Walsh could easily follow that protocol. I think it's a good protocol that he speaks to the American people, especially since he's a new chairman. Now, Powell's still going to be there. I believe he is. He's got a good couple of months, up to about 6 months, in which he's still going to be a governor, no longer the chairman. So you've got Powell there, but I'll be interested to see what Walsh says, and most importantly, with the Fed, I call it Fed speak. What they say, you have to read in between the lines. And then most importantly, the statements are the same statements from the prior FOMC, where they change the language of a couple of sentences maybe, and see what changes are in there to get an idea of the forward path and thinking of the Fed. And that's really going to be, I think, the most important economic news that comes out this week.
Okay, good. Thank you very much, Gary. We'll keep tabs on the new economic developments from the FOMC, and we'll keep tabs on gold. We'll speak again soon, Gary. Tell us where we can follow your work for now.
Thank you so much for asking. To look at like 2,000, 3,000 daily videos that we put up since 2010, YouTube, the Gold Forecast is our channel there. You can also read our daily letters on our site, thegoldforecast.com. And as I haven't done this in a while, but I want to do it for your viewers and subscribers, and you do such an excellent job, I want to offer, for those that are interested in our premium service and see value, try us out. We'll give you 30% off when you fill out the form. Just put Lynn, L-I-N, in the coupon box, and it will automatically be discounted by 30% on thegoldforecast.com.
All right. Thank you very much. We'll put the links down below. Appreciate the vote of confidence. We'll see you soon, Gary. Take care for now.
Thank you so much.
Thank you for watching. Don't forget to like, subscribe.